Leveraged ETFs can literally supercharge your returns, but it's not without risk. You're going to see higher overall volatility of the portfolio. So the goal of this video is to walk you through how we can trade something like my favorite strategy, the covered strangle, in something like a leveraged ETF such as TQQQs, and how we can build a system around it to strike a balance between our return potential, but then also managing our risk side of the equation. So let's get right in. This is what we're going to run through. We're going to go end to end. I'm going to walk you through some high level concepts, and then we are going to get into some details on how to think about and form this kind of thing for yourself. So let's get right to it. Very first thing is the covered strangle. For those who are unfamiliar, I'll throw a link in the notes below, but it's a bullish trade. We're going to be long shares, sell cash secured puts, and have ratio short calls against the long shares. We'll have more details on that in a little bit, but that's the overview for the strategy. Now, the whole idea of a leveraged application is to amplify your returns through additional beta. What does that mean? Let me show you. If we pop over to the platform and we take a look at QQQ on the left-hand side here, this is a 5-year weekly chart. I want you to notice the move that happens here. It goes from 402-ish down to 261-ish. This is from 2022 into 2023. This is actually during the bear market that we had that year. If you look at QQQ compared to TQQQs went from 91 down to 17. Notice the difference. Qs is about a 36% drop. TQQQs is an 80+% drop. So if you have $100,000 through here, at the end of it, you have 20. That's difficult for people to manage. And most people bail on this during the worst possible time, which is as it's in this free fall. So we're going to talk about how we can manage this additional beta so that we can actually take advantage of the leverage without taking on excessive portfolio volatility. So what does that mean for best practices? Well, we're going to have to pay attention to notional sizing because something like TQQQs is 3 times leveraged the daily returns of QQQ. So it's essentially behaving as 3 times the number of shares on an intraday basis. Now, volatility decay refers to how leveraged ETFs behave. To summarize this at a high level, it essentially means volatility is going to be exacerbated during prolonged consecutive down periods because of the sequence of returns. So if we take a look at this quick example here, you can see I'm showing you a prospective return sequence for QQQ versus TQQQs. And TQQQs, we're calling it 3 times the daily return of QQQ. This doesn't take into account the fact that there is a discrepancy between these. It's not going to be perfectly matched. Sometimes it will be slightly more, sometimes it will be slightly less. But just for the example of volatility decay, I'm using 1-to-1. So for QQQ, if we have a 1% day, a negative 2% day, followed by a negative 5% day, followed by a negative 2% day. That's what this math is showing us. This is day 1, day 2, day 3, day 4. So the required move to get back to break even here is 8.52% if we have this sequence of returns. If we do the same in TQQQs 3 times levered, the required move becomes 29.27%. What does this mean? This is volatility decay, because now if Qs shows that 8.52% move, Qs is now back to break even, but TQQQs is not, because that only translates to a 25.56% move in TQQQs. So then we still have another several percent to go to get back to break even. And for a quick visual of this, this is exactly why if we compare this period from Qs to TQQQs, take a look. Qs already passed and started making highs off of this period in here. TQQQs still hasn't gotten back to highs. This is volatility decay. It's because of this period here. So what that tells us is we have to be very, very thoughtful about avoiding that volatility decay. Otherwise, it can be a problem for us. So now let's talk about the strategy. I already have a series that I'm building around this. I have 2 videos that I've done outlining this kind of pretty far in depth. So I'll link to those below. And I'm also going to start reviewing this on the Monday night YouTube live session. So you can check in for updates on it there. I'm using real money. It's for an example. So let's take a look at how to build a strategy around this. We use the outlier strategy process. So we're going to analyze the profit mechanism, the mechanism indicators. We're going to find structures that fit, and we're going to build a strategy. In this case, we're coming into this problem set knowing the structure that we want to use. We want to use a covered strangle. Why do we want to use a covered strangle? For a bunch of different reasons. But in this case, this is designed to be a little bit more of a hands-off approach to trading leverage. So this is something that I might run in an IRA account that I'm not necessarily trading a ton, or a 401k account, or if I was on active duty in the Marine Corps and I was going to be deployed for a while, something like that. So this is not designed to purely optimize best possible return and risk profile. We have the added adjunct of wanting to be a little more hands-off, less babysitting. So what does this look like? Well, the profit mechanism here is pretty simple. It's going to be capital gains via trend, drift, and beta. This is essentially how we're going to use something like TQQQs to outperform buy and hold in QQQ. So the profit mechanism traits and indicators are pretty simple. We know as traits that we're looking at something that's very volatile. It's 3 times the daily leverage, which is really important to track, and it's going to have excessive beta compared to, again, the non-leveraged counterpart. So it's going to move around a lot, and it's going to have options that have good volatility in them, which is why the covered strangle is a great fit for this. For signals, in terms of determining if we want to get in, if we want to get out, if we want to scale up, if we want to scale down, we can use things like moving averages, standard deviation channels, RSI, kind of my standard technical analysis tool suite, which I'll link to a video below that goes through that in detail. But most of this is going to be stuff that I'm going to look at to make adjustments relatively infrequently. This isn't going to be something I'm day trading. So our signals have to match the overall time frame. The strategy, as we already discussed, is going to be a covered strangle. Other things that could fit into this are ratio call diagonals, buy and hold with different kind of exit protocols instead of just holding through things, that kind of stuff. So what does the strategy itself look like in this case? Well, we're going to make sure that we're long at least 100 shares to preserve upside potential and to allow us to sell calls against the longs at a ratio. And again, if you're unfamiliar with what that is, check out that video below. We're going to sell cash secured puts. Both of these are going to be within the 50 DTE window to maximize theta decay, but we're not doing super short term so that we're having to adjust it all the time. We're going to focus on rolling to maximize profit over basis adjustments. So we have to pay attention to when we choose to roll because we want to make as much money as we can in the scenario versus worrying about updating our basis. Risk is going to be managed primarily via size. I already showed you, and I will show you, additional drawdowns, but in a recent example, we had a 82% drawdown. I don't want to do that. So we're going to have to find different ways to navigate around that drawdown so that we're not experiencing that. Moving averages to set entrance and exit triggers, completely viable. We'll talk about some different variations of that. It can help a lot. Otherwise, you can use sizing as another method to decrease your overall risk. And then for me, I'm going to use a 5% move as my scale window. So if something moves down 5%, I'm going to decide scale in, scale out, stay the same. But I'm going to use that as a trigger to modulate how much money I'm using when, because one of the most important things during this kind of down move is to have enough money to scale into the trade as it's plummeting so that you can improve your basis so that you can hit your recovery point much sooner. Because if we take the example of top ticking it, you bought it here, for example, at 90, you take the crash down here to 16, you're still not back to break even. But if you were just 35% invested here, and then every 5% drawdown, you added a little bit up until you added 3 times in the course of 2 weeks. Then you stretch that out to maybe adding on 10% drawdowns until you're fully invested towards the bottom here. You already hit break even and you're making money again. The scaling element of this is going to be very, very important. So quick overview. This is from Portfolio Visualizer. This is just showing the difference between TQQQs and Qs for total returns, annualized standard deviation, which is really important. And then also drawdowns. Again, this is not fully correct because I'm showing you on the chart there what it actually looks like, but it's pretty close. So this is showing you that if you buy and hold TQQQs, you can have some really great years. However, you're going to have potentially really bad times.
These are real bad times, bro.
So now let's talk about how this overall system performs. So what I did is I just ran through Python. And I plotted a couple different moving averages, a 22 period, a 50 period, 150 period. And then I looked originally at buy and hold performance in TQQs versus Qs from 2010, comparing the maximum drawdowns, which we already knew this. This is just a visual representation of it. So what my mind is thinking, maybe we can use moving averages to cut this. And if we take a look at something like this, where the number of touches for a 22 versus 50 versus 150, you can see that the shorter term the moving average is, the more frequently it's going to be interacted with. Some of these other numbers down here are not accurate. You can ignore those. This is literally just for the touches. So at a quick eyeball of just using a very basic straight entry exit criteria, you can see that we can manipulate a TQQQ strategy to very much outperform Qs, and we can also decrease the maximum drawdown if we're really thoughtful about these levels, which again, this is not. This is just a dumb system. So there's a viable approach here if we can manage these drawdowns. So now the name of the game is seeing how do we participate in these 3,270% gains over these time frames without giving up too much upside profit potential by getting out using different moving averages without going through these 82% style drawdowns. So one of the first things you'll notice is that the 50-day moving average works really, really well. So if we use a 3-year daily chart, you can see that if you use a 50-day moving average, it would get you out much, much, much sooner in the lifespan of the trade, so that you don't have to go through this really drawn out, nasty drawdown. So for example, here using 3-year daily chart, you can see that, let's say you got in here, it would keep you in, you might get out somewhere in here, get back here, get out again here at a small profit. You take it all the way to the downside, come back up, get back in here, get kicked out again here for a small loss, then you're not back in. So you can see that there's still quite a few interactions with the 50-day moving average. So there's a couple choices we can use. We can either use a 200-day moving average, which is going to be much slower. You're going to have a bigger drawdown before it kicks you out. But in this case, let's say you top ticked it again at 91. This might kick you out instead at 68. So it's not a great move, but it's not going from 91 down to 16. And if you use a 200-day moving average, you get in here, bad timing, top ticked it, gets you out here at 68, and then you don't get back in until down here. You get chopped up a little bit, then you get chopped up again a little bit here, but then you're essentially off to the races into here. The downside is that this move would have got you in full from 85 down to 59. So what we can tinker with is using a combination of these different moving average strategies so that we can maintain some sensitivity and strike a balance. But this is the introduction to using covered strangle in a leveraged ETF. If you're interested in following along, check out those Monday night YouTube live streams. And then the other thing is, if you're interested in another follow-on video that talks about the specific relationships with these moving averages that I'm going to use, let me know and I can share with you what I'm going to do and why I'm going to do it. As always, if you have any questions, let me know. Be an outlier. I'll see you all later.